Welcome to the Best of US Investors 2 Regular Guys show. This is Mark over here, and I'm Trent. And today we're going to get into, some good news, some bad news, and some good news about the economy, what is happening, market valuations, along with maybe some ideas on where the next opportunity is with this whole AI revolution. So let's get rolling. Hey,
All
Mark.
right. What are you doing down there in Round Rock? Having fun?
Round Top. Oh
Round
yeah.
Top. That's it. Round Top. Okay.
Round Top. Oh yeah. There's always, every one of these shows, there's always some sort of a political event going on, not a president election or anything, but things get a little political between, you know, people and companies and stuff. So it's interesting. It's nothing really different. Human beings are really pretty predictable, if you ask me. But yeah, to me, this represents the middle class and upper class, and they got T-Rex arms. They can't reach their
Yeah.
wallets like they used to. Hey, hold on. No, I can't get that. No, uh-uh.
Well,
So we're seeing a little
probably
bit. We're seeing that.
they've
And
pro-
I think
they've
it's,
probably they've probably seen their credit card bills, so they're trying to
yeah,
cut back. So
yeah, yeah. So anyhow, it's everything we've been talking about for a long time about the economy is pretty much rolling out in front of me. Um, so it's like a vendor pointed out to me. I've been selling a lot of stuff below $500, but anything over 500, their arms get shorter, and when you go over 1,000, their arms disappear.
yeah.
So they can't reach their
Yeah. I
wallets.
mean, I always tell everyone, you know, don't believe what you're told by these reports. Just go out and look at where you live and what's happening, and talk to people, and you'll figure out pretty fast what's reality and what isn't.
Right.
So
Yeah. Yeah, that's sort of what it is. Yeah.
good.
What's on your mind?
Well, Well, I'm going to start out, with not a rant, but let's start out with some good news. Okay. Which I know no one's used to that from me, but I did find some. It's the Boeing strike. Okay. So the Boeing as leaders of its machinist union have reached a tentative deal that could end the strike that's halted most of their production. So the company's offering 35% wage increase over 4 years in its latest proposal, and that's up from its original offer of 25%. That was overwhelmingly rejected by a union representing the local machinists in the Pacific Northwest. The union plans to vote on the deal tomorrow, Wednesday. Today's Tuesday, 2 weeks from the election. And I'm glad that'll be over and don't have to watch all these ads anymore.
Right.
So the union's going to vote on the deal tomorrow, Wednesday, when we'll probably see our video out. And nearly 95% of the workers voted to reject the last deal, which the union leaders recommended. So it's not set in stone, but at least they have something they're going to present to their members. So there's your good news. Now let's get back into the rants. But I want to talk a little bit about market valuation. I saw a couple pieces and stories this week about market valuations and people who are pretty good in the markets. One of them is someone I like to watch. He's David Rosenberg. He's an economist, and he was known for one of the guys that predicted the '08 market crash and recession. And he's kind of in that mode again. He's talking about a mega bubble. Okay, and he put out a note to his clients uh, that the bear market warned that the current market is a mega bubble and cautioned his investors against chasing the momentum. We have a lot of momentum in this market. You can go, and there's a lot of momentum traders out there right now, and just chasing, which is okay, but you need a plan in case that momentum. The thing about momentum is it can stop pretty quick. It's like when you shoot an arrow up in the air, it goes really fast until gravity holds on, and then eventually it'll come back. You got to be ready for it. Makes that arc and comes back down. So he says when this mega bubble pops, it will be spectacular. He wrote this on October 18th. There's no time to chase momentum or the herd mentality, he said. He said Rosenberg cited high valuations, investor positioning, and sentiment as warning signs. The most recent AAII sentiment survey, okay, that's the American Association of Independent Investors, which tracks investor sentiment, shows 45.5% of its respondents characterize themselves as bullish, and that's above the historical average of 37.5 for the 49th time in 50 weeks. This is the mother of all momentum-driven stock markets, he wrote in his October 9th note. So what he's saying out there is, we're starting to see uh, investors, traders, regular retail people get really excited about this market and are starting to chase. And we've already talked about how many, Buffett, uh, entire staff at NVIDIA, Tesla staff and executives selling their stocks. Okay. JP Morgan, Jamie Dimon sold. Okay. Just a whole bunch of them. And why are they selling now? And then all of a sudden we're seeing that the retail investors are piling in. And this is something we've seen before, you know, before they got really hurt. So I just wanted to think about this a little bit. And Rosenberg's been around a while. So he warned that the S&P is at least 25% higher than fundamentals suggest it should be, with stock prices outpacing earnings growth and the analyst EPS revisions trending to the downside. Okay, so I'll get to it a little later, what the revisions to earnings are supposed to be. And people get into this, earnings always go up, stock market always goes up, and they start chasing, and it's fear of missing out. So he's bearish on the economy as well as markets and anticipates a recession on the horizon. He pointed to emerging signs of economic weakness, including a rise in unemployment and decreasing job openings, which we've been talking about for months. Rosenberg warnings come at a time when the S&P has seen significant gains, up 23% year to date, following gains of 22% in 2023. Investors can track the S&P 500 through funds that track the index movements, including the S&P 500 or the SPY, and iShares Core S&P 500, the IDV. Rosenberg cautioned investors against chasing overvalued market and advised clients to preserve their capital. And he went on to say, J.P. Morgan, the original J.P. Morgan, not the bank, reportedly once commented that he got wealthy not by buying at the lows and selling at the highs, but rather by being involved in the middle 60% of the bull market. He says, well, we are well past that moment right now, Rosenberg wrote. And I think about that too with our swing trading. We're not trying to buy at the low and sell at the high. We're trying to get the middle between the lines. We're trying to do small ball, bunts, singles, and doubles, not going for the fences. And that's exactly what he's talking about. So, kind of in unison with this, Goldman Sachs came out with a view of market valuation this week. And this is strategist, his name's David Kostin, and he estimates that the S&P 500 index will deliver an annualized return of only 3% over the next decade, well below the 13% returns of the last 10 years and the long-term average of 11%. That's also down from the investment bank's previous projections, which put the S&P 500 index as 8% annual total returns during the next 10 years and falls below consensus estimates of 6% total annualized growth in the next decade. So the main drag on Goldman's forecast is due to an extremely high level of market concentration, particularly when it comes to the top 10 mega cap tech stocks, he wrote. And we've talked about this. These top 10 companies, which include Apple, Microsoft, Amazon, NVIDIA, Alphabet, Meta, okay. We also have Berkshire Hathaway, Lilly, those type in there. They account for 36% of the overall index and are driving much of the return. So far this year, these leading firms have returned nearly 47% compared with 36% for the index as a whole. So, 10 stocks are providing 47% of the return. The rest of the 490, 36% of the return. So the premium valuation for the top 10 stocks is the largest since the peak of the dot-com boom in 2000. Okay. So I go back in history and say, okay, well, that's kind of a flag. So when you think about it, according to Bloomberg Intelligence, companies in the S&P 500 are expected to post an average of increase of 4.3% quarterly earnings for Q3 compared to the previous year, and that's down 7.9% growth projected through mid-July. So you've got Rosenberg, you've got Goldman Sachs, and now you've got Bloomberg all telling us don't expect these earnings to be as blockbuster as they have been. And you think about, well, why would that be? What has happened in the last 10 years? Well, we had zero interest rates. Okay. That's one of the big correlations. It's not all that, but that's what it is. Now interest rates have come up and we're seeing them go up even further. Okay. And we'll talk about that just in a little bit. So how is all this affecting small business? Because, the big businesses, we're looking at, the Mag 7, everyone's into them. But a majority of the economy in the United States is small business by a long shot. Okay. So according to business networking platform, Alignable September revenue and rent report, 48% of small business renters could not make their rent payments. That was up from 41% in July and August. And it was the highest it's been since the COVID recovery era in March of 2021, when 49% of small business owners were delinquent. That's back in COVID. Additionally, the report highlighted a cash crunch among small business operators, with 43% saying they only have 1 month or less of cash reserves, a 14 percentage point increase from August. So think about that when small businesses, and when you drive down your main street and see all the small businesses and think about what's happening. So we watch CNBC and we're going to watch, halftime report, and every stock is great, and don't worry that it's down, and the economy's good. Steve Leisman comes on, he's all smiling ear to ear, and everything's fine and dandy. Just walk down your main street, ask people, go to a restaurant, see what's happening in a restaurant midweek. Is anyone in there? Are they closing early? Do they have any staff? Take a look around and decide on your own. So
Yeah.
then the IMF, the International Monetary Fund, put out a report, or no, actually, one of the spokesmen came out and talked about prices in the world. Higher prices are here to stay, which adds to an economic pain also stemming from slow growth and high debt. The International Monetary Fund's managing director, Kristalina Georgievna, said on Monday. I think I got her last name wrong. The pain we all feel because prices have gone up is here to stay, and a higher level of prices makes many people around the world quite angry too, she said in a speech at the Bretton Woods conference. So she was at Bretton Woods talking about we're not going to see these
Wow.
prices go down. Even though they tell us that inflation is under control and inflation's come down, it has not. The rate of inflation has come down from 9% to 3 point whatever, but we're still up 20, 30, 40%, depending on what you're looking at, whether it's energy, whether it's housing, whether it's insurance, it's all up and hasn't come down. And they're saying they expect it not to come up, not to come down. What's the other thing, that high rates uh, will mess with, along with increased spending? That's our U.S. budget deficit. So the U.S. budget deficit grew to 1.833 trillion for fiscal 2024, the highest outside of the COVID area, as interest on the federal debt exceeded $1 trillion for the first time, and spending grew for Social Security retirement programs. Well, a lot of people are retiring and getting older. The baby boomers are moving through, and I'm one of them at some point.
Yeah.
I'm at the last 2 years of the baby boomer. I could probably get, I could probably get moved over into the other side if I needed to. I don't even know who's after the baby boomers, but I could probably move into
That's
that
my
if I needed.
generation.
Yeah, okay, I'd be in your generation. Okay, yeah, I'm sure you guys would vote me in. Anyway,
Oh, absolutely. Absolutely.
uh,
Ah,
Social Security, healthcare, and military. Okay, that's what the Treasury Department said. The deficit for the year ending September 30th was up 8%, or 138 billion, from 1.695 trillion recorded in fiscal 2023. It was the third largest federal deficit in the U.S. history after the pandemic relief driven deficits of 3.12 trillion in fiscal 2020 and 2.77 trillion in fiscal 2021. U.S. receipts for 2024 fiscal year hit a record 4.919 trillion. So what we took in went up. Okay, so we don't have really a revenue problem from what I'm seeing in these reports. We have a spending problem. We're up 11%, or 479 billion from a year earlier, as individual non-withheld and corporate tax collections grew. Okay, fiscal. And remember, we're still under the Trump tax cuts, where they said, that would no one would, millionaires and billionaires and companies wouldn't pay their fair share. It's up, okay, including corporate tax collections. Fiscal 2024 outlays, what we spend out, rose 10%, or 6.17 billion. So we brought in 479 billion, but we spent 617 billion, 6.75 trillion. So again, we're spending more money than we bring in. If you did that, if I did that, Trent, we would go broke and no one would
yeah.
care. U.S. government can print its own money, sell it off in treasury bonds, sell it off in
Right.
treasury bills. So what was the biggest driver of the deficit? It was a 29% increase in the interest cost for treasury debt to 1.133 trillion due to a combination of higher interest rates and more debt to finance. So we're putting out more debt at a higher interest rates. And for us, it's been great here in the Platinum Channel because, for a lot of us, we're parking cash, we're parking in treasuries, and we were up to 5.6%, 6 months ago. And right
Yep.
now we're sitting at 4.7. And on a treasury bill 30-day and just keep rolling it over, not too bad. Get a little bit of a
No.
tax break on it, so it's good for us, but we're paying for it as a country. Okay. So total exceeded outlays for uh, Medicare health programs to senior. Hold on. Treasury debt to 1.33 trillion due to combination of higher interest rates and more debt to finance. The total exceeded outlays for Medicare healthcare program for seniors and for defense spending. So what we paid out, as far as our debt, was what we pay out for Medicare and for defense spending. Other drivers of increased outlays, and these are expenditures for the fiscal year, included Social Security up 7%, Medicare up 4%, and military programs up 6%. So there's an issue that, we were talking about before we started this video, that it's not just a we don't have enough money problem. It's a spending problem. We have enough
Yep.
money. We're just spending way too much. And I don't
Yeah.
hear either side talk about cutting spending. I guess I do a little bit. Elon Musk gets in there. He's going to be the czar of cost cutting, which I think this country could use. Okay,
Yeah.
just like anyone, if you have a wife or a husband that overspend, you got to sit down and give them
Got to cut.
an interference, as Kramer on Seinfeld would say.
Yeah.
We can't spend more than we make. We're seeing that though, even in the consumer. So we'll move on. This week, the Conference Board of Leading Economic Indicators came out, and the Leading Economic Index provides an early indication of significant turning points in the business cycle and where the economy is heading in the near term. Weakness in factory new orders continued to be a major drag on the U.S., the leading economic indicators in September said, as a global manufacturing slump persists. We've been talking about global slumps. Okay, we've been talking about uh, manufacturing indexes in the 12 sectors of the Fed. We've talked to members in our own Platinum channel who run manufacturing companies and said, no, it's not doing well. I don't care what the
Right.
report said. Okay. This is a senior manager of business cycle indicators at the conference board. Additionally, the yield curve remained inverted, building permits climbed, and the consumer's outlook for future business conditions was tepid. Gains among other LEI components were not significant enough to offset weakness among the four gauges mentioned above. Overall, the LEI continued to signal uncertainty for economic activity ahead and is consistent with the conference board expectation for moderate growth at the close of 2024 and into early 2025. So again, these are the leading economic indicators, not the lagging. Um,
Right.
and again, take it for what it's worth, but go down to your local mall, go down to your local restaurant, local hardware store. If it's open, True Values are being bankrupt now, but we'll see.
Right.
So
Huh.
the other thing that's on my mind, do you have anything to say about that?
Now, let me show you a chart real quick, Mark.
Okay.
Um, this is, let's see here. This is inflation going back 10 years,
Okay.
32%, up 32% since 2014. If I go in
Yeah.
here and I plug it into 2020, and let's see here. Let's say January 1st, 2020. Inflation's up 87.04%. So when they
Amazing.
come out and say inflation is declining 2 point whatever, 9, whatever percent, that's declining off the 87% increase in inflation since 2000.
But it's not even
Look,
declining. They're just talking about the rate of increase has
right.
gone from 2.9 to 2.8, but it's increasing every month.
Yeah. And if you
Yeah.
look at here from 2020, when it was 52.69% to today, or till since August 11th, 2024, going back to then, it's up 86. Just in that time, it's 30% increase. 30%. I mean, that's a chunk.
Yeah.
That's a chunk. and it's not stopping. So when they say they have inflation under control, I look at this chart and I go, I've seen from inflation go from 52.69% to 87.04% in the last 4 years.
Yep,
That has hit my pocketbook. That has hit
absolutely.
everybody's pocket.
Well, and,
Yeah.
and that's because they use reports like the CPI and the PPI where they pick and choose what they want to look at. And again, those show rate of increases. Okay. And they're, remember the Fed was hell bent on hitting 2% rate of increase, and we never got there. And now you look at CPI and PPI, they're starting to turn up. The last report, they both went up on core. Okay. And we'll talk about that here. And I'm glad you brought that chart up because it's a good chart and explains a lot to people visually what we're looking at and why you're feeling the pain you're. And then you see those news reports, well, I just can't understand why people don't see how great the economy's doing. What's wrong with them? Well, these are normally, by these anchors at financial news networks or have $1 million, multi-million dollar, contracts. They ride to work in cars provided by the network. They fly around the country. That's not us. That's not regular guys and gals. That's them. No wonder they don't feel the pain. Okay, and so when you when you think about it, that's what the 10-year Treasury is telling us right now. Okay, so everyone says, oh, the Fed lowered the rate, 50 basis points. Okay, so that's the rate that they loan banks. Okay, it's not has nothing to do with it. It's on the lower end of the scale. Okay, so it might affect a 2%, maybe. It's not going to affect the 10, it's not going to affect the 30. 10% went up. Then what happened? Well, when the 10% goes up, Treasury bond, mortgages go up, mortgage rates go up, mortgage rates went up. The 10-year Treasury yield sits close to an almost 3-month high after having risen 55.8 basis points as of Monday from its 52-week low of 3.622% on September 16th. Okay, and that's about when they lowered rates. Okay.
Yeah.
Meanwhile, the yield on the 2-year Treasury was about 2 basis points higher at 4.047. Rates go up when there's pessimism that the Fed won't be able to be as aggressive with rates cuts moving forward. So what's happening is the bond market saying, okay, we're seeing inflation go up and we're seeing unemployment, even though through your reports we dig through them, unemployment's going up. Okay. And what that means is recession. And the bond market's telling us by going up, we don't believe you. And Fed, you're not going to be able to lower rates anymore. You might actually have to reverse course and raise rates if inflation takes off and unemployment goes up. And that's happened before under Greenspan and Bernanke. So we have history of it, and we'll just see. But I think they're just trying to patch this together and get us through this election. And
Yeah.
and it could be like, had you ever seen the Blues Brothers,
Oh
the
yeah.
movie? So
Yeah.
that they got the Bluesmobile, which is an old Mount Pleasant police car, and they run the crap out of it, and all these cars chase it. And when they finally get to their destination, they get out, and all of a sudden it just blows up and
Just
just
falls.
falls apart. That's what
Yep.
I think I see coming. I was like, that's our economy. It's just gonna go boom, and
All the sheet metal just fall off it.
yeah, and
Yeah.
then start smoking and everything. It's done.
Right.
If they kept it as far as they could, and to me, that's what I'm seeing. Okay, I don't know that for a fact. That's my own opinion, but man, watching this thing for a long time and going through several of these before, it sure does. It sure does. You know, if it looks like a pig and oinks like a pig, it just might be a pig.
It's a pig. I
Yeah.
was thinking about this as you were talking about having to raise Fed funds rates again. Um, the last 4 years, I mean, rates were almost zero for most of it. For roughly of the last four, um, for at least half of it, rates were zero, and we had this massive inflationary environment where people had money, cost of goods went up. We see that in that chart I just showed. If they have to raise rates again because inflation rises again, that really stagnates our economy. I mean, the 30-year mortgage is almost at 7% again. You talk about killing the housing market. It really puts a damper on it. So it's like, okay, so do you raise rates, cut them another 50 basis points over the next, say, 6 months? Hopefully, it'll juice the economy well enough that they can maybe inflate their way out of it. Is that is that done?
Inflation,
Has that been successfully done in past?
no, inflation is a tax on the poor and the middle class. Okay. And all that's going to do is take more money from them and they won't be able to spend. We're already taxed to the nth degree. Our credit cards are maxed out. Okay. Uh, our house maintenance and insurance and property taxes have gone up, and our salaries have not matched that. Okay, so if we start getting, you know, increased inflation and the economy slows even more and more people get laid off. And again, we looked at the jobs report and it was mostly all, temporary government jobs and that Steve Leisman won't tell you. And it was restaurant workers, and that was it. Uh, but if we start getting unemployment, people start losing their jobs, and they have all these credit cards, and they can't make their car payment. Um, People are going to start losing their houses, and I don't care what the rate is. There's no one going to be out there to buy these houses, except Warren Buffett maybe or BlackRock, and they
Right.
seem to be dumping them right now. So
Yeah. Well, I guess I wonder is if you see a rise in inflation, what asset classes do well? Do we see a rise in energy costs? So you know, Exxons of the world, Chevrons, those companies, do they reap benefit from a rise of in inflation for a period of time?
well,
Um,
I think you got to go to utilities, where you have everyone's got to pay utilities, and then they have dividend stocks maybe. I
yeah,
think you need to go uh, consumer staples. People got to buy
yeah,
stuff that they got to have. They're just the
necessities.
safety. Yeah. And
Yeah,
if the market goes, you can always go back to the long bond, which is always, it's not there yet, but um, you know, when the long bond goes and the yields go down and the long bond price goes up, and you can go back and just look at the charts. Every time we've had a recession, what happens to the TLT?
yeah,
I would assume it's probably going to do the same thing. I don't know that for sure, but history tells me it will. You know,
yeah. I mean, you look at where the 10-year yield is today. I think it's like at 4.18%. It's had a gigantic move since what, the 11th of September, I think is when you raised
September
rates.
16th. Yeah, so right about the same time they lowered rates by 50 basis points. We just went
Yeah,
over that. Yeah,
yeah. So I guess, is the opportunity in the
it's
commodity
gone up
sector short term.
55.8 basis points. It's gone up since that time,
That's amazing. But
and
so if
and and that was when the Fed lowered rates by 50 basis points, and then the market said,
yeah. So and I think that's the thing is like if he lowers them another 25, which is what the talk is before year end, does that mean the 10-year goes even higher? I mean, or does it reverse out of fear? I don't know. I don't know. I think I look at the 10-year yield and I'm like, you could see a pullback, maybe back down to 4% again. But 3.6, I don't know. I don't know. I think this we're in a weird time, like you and I were talking earlier. We're just at that point where it's like whatever they do, it's sort of screwed. You know?
yeah.
Um,
Well,
yet
I mean, you got to be vigilant, and if you have investments, know what you have, why you have
yeah,
them, and risk manage. If you don't risk manage, no one else is going to do that for you. Okay, why do you have insurance on your house or your car? Risk management.
that's my age.
Okay.
Right.
What do you have on your investments? That's risk management. Anything? You
Yeah. I mean, you look at, NVIDIA, of course, hit $3.5 trillion market cap the other day. Um, it's once again, it hit a resistance level. And last I checked, it was not penetrating that. So chances are there's a pullback. So, a bunch of people piled into that thing, right around 130. And those institutions have driven it up. They're getting out of it, and now you got the retail investor piling into it again. And they'll take it
Yeah,
right back down to
and that's
130.
and that's how they get out of it. They can't do it all
Yeah,
at once because they own so much of it. So they
right.
bait you in, and then they take it down. They bait you in, and when they're all out of it, that's normally when the rug gets pulled,
Yeah,
and then you're sitting there going, "But it's Nvidia. It'll be here forever. It's Enron. It's Enron. How can it go out of business?" You know.
right.
And I had to
Well,
live through that
good.
too. And people are buying Enron all the way down to when it crashed, and I'm like, why are you buying this? Well, because it used to be at 80 and now it's at 42 cents. But so
Why
that
is it
should
at
tell you
42
something. Yeah,
cents?
yeah,
Yeah,
exactly. So
yeah. I don't know. It's just I'm looking, I would love to have a bull market again
well,
in a
technically we have a
situation
bull market.
where the economy is strong.
Yeah. Yeah,
Yeah. But the problem is right now we have the economy is weak and and we do have a bull market really
we
in
do.
just a handful of companies if you're looking at the S&P or the Nasdaq. Um, but how do we get back to a point where the economy is strong and the stock market is strong equally?
Well,
How does that
we
happen?
thought we just talked about valuations. The market's overvalued.
Yeah,
It's overvalued. And
25%.
everything comes back to the mean, and you got to go back to the mean. And sometimes it goes under the mean and below. Okay. And what we have is a policy in place with the Fed that the market can never come down. And instead of focusing on inflation and on unemployment, it seems that they focus on politics and the stock market, keeping the stock market up. And that's not their mandate. Okay. It is not their mandate. And everything needs to cool. Nothing can go up forever. The party doesn't that once the music stops, you better have a chair. And the guys in the institutions, they always have chairs. In fact, they have couches and love seats and recliners. We might
Right.
get a stool if
Yeah.
you're lucky.
Yeah.
No, I'm
I
trying to. I'm just saying that the stuff we go over for regular guys and gals, it's normally not stuff that anyone tells you. So
yeah.
if you want happiness and butterflies and unicorns, you go to CNBC and watch Steve Leisman and Andrew Ross Sorghum and all those people and watch the halftime report where there's not one bad stock in the history of the world and everything goes up every day and you'll be happy. But
Yeah.
then there's the other side of the world, which I call the real world that we all live in, as regular people. And the market's not the economy. We talk about that all the time.
Yeah. I think one thing it does well in a stagflation environment. I refer to that as sector three, and that is, of course, utilities, healthcare, financial. But here's the thing: when Bank of America reported, um, when Goldman Sachs reported, who Citi, J.P. Morgan, Chase, they all have credit card exposure. And they are all
Yep.
talking about how their credit card exposure is basically a thorn in their side. And they're
Oh
seeing the
yeah.
default rates go up. If you can find a financial institution that doesn't offer credit card debt or some sort of that would potentially be a strong play because now they're making more money on that spread because they're able to they're not lending out what they're borrowing at in a sense. Is that or a reverse of that? Um, the problem is how do you find those companies that
So
don't
what?
have the debt exposure of a consumer,
Well, so banks lend money. That's their business. Okay.
right?
So what sector of the economy are you looking at? Where they're lending money to something that's safe. Is it commercial real estate? Nah.
No.
Is it small business? Maybe not. Is it the consumer? Mm, probably not. Okay. And they're not lending anyway. We've talked to, our business owner members who say, you can apply for a loan and do all the things. By the time it gets to the desk, so hey, thanks for doing this and denied, because they don't want the exposure.
Yeah,
And that's
yeah,
what's happening. The banks are putting together higher reserves now to counteract these delinquencies because they learned from the days of Lehman.
Hmm.
They don't want to be the next Lehman.
Yeah. So does that squash the theory that banks, financial institutions do well in a stagflation environment?
Well, no, because if you're too big to fail, the government will always bail you out. And who does the Fed really work
Yeah.
for? Banks.
The banks.
That's who's on their board of directors. The big banks.
Banks. Right.
They own
Yeah.
the Fed. They own the shares in the Fed. Look it up.
Yeah. True. Hmm. Yeah. I don't know. It's just a weird time. Weird time. It's a very cautionary time. You see the movements in these companies. You know, I track NVIDIA every day. So we offer a free price projection uh, email each morning. And every time I write in the comments, be patient, protect your assets, beware. It's going up. Yes. It's hitting resistance levels. Yes. All-time highs, all-time, large market cap levels, but it will not last. It will not last. And I think that's that risk management. That's that trailing stop that you put in. You talk a lot about that on the
Yeah,
Platinum channel.
but we do, and that's why on the Fiveman channel we looked at technicals because fundamentals are kind of out the window for most of these stocks. I mean, if you look at them, they're way overvalued. And that's big fundamental, and
Yeah.
it's a lot on hope. And you know, you talked about Nvidia. Nvidia had excellent earnings last time, but 122% increase. But you look back a couple of quarters like you did and said, oh, that's coming down. It was 200 and whatever, and then it was 175. Now it's only 122.
Yeah.
So we're seeing slowdown,
I
but it
actually,
doesn't get reported that way, does it? Doesn't get
no,
reported that way.
I actually went and did a sort of a calculation on their earnings projections, the rate of change that you'll see. So, for instance, revenue went from first quarter at 265 to 122 in second quarter. And what I'm projecting there is about an 82% increase in revenue. So it's slowly the revenue is declining. And it's similar to earnings per share. I think I had it at 70 and it's been much higher. But that rate of change is declining because they had the big push in '03, 23 through 24 when it comes to purchasing. And they've introduced a new product, but the consumer doesn't have, or the corporation doesn't have the buying power they used to because cost of borrowing has gone up. And so when the cost of borrowing goes up, they have to buy less. So you're starting to see those revenue changes, the rate of change in revenue and earnings per share, along with other things. I was looking at Kerry uses on the cheat sheet the growth of employees annually. And if you go back and you look at NVIDIA as an example, I think it was 22, they had a 38% increase in employee count. So they hired 38% more than previous year. Well, that number has declined as well. And now it's in the teens. So to me, when I look at these things, when you get into the fundamentals, and Kerry does a great job on that on the Gold channel with his cheat sheet, is you start to look at rate of change of these fundamentals, and you're seeing these corporations are slowing. And I would be, Nvidia will come out with good earnings, but if you look at the rate of change compared to quarter after quarter, year over year, it's slowing and it's slowing. And if the Fed has to raise rates again because of inflation rising, you're going to see a rapid change, growth decline. And that's where you start to look for asset classes where it performs well in a stagflating environment, like you've been talking about for quite a while now.
Ever,
So
ever. Yeah.
yeah, but
Well, I mean, there's still good news out there though. Like
absolutely.
the IRS gave us good news today. They're talking about the tax rates for 2025. Okay. So, and standard deductions. So they've announced new federal income tax brackets and standard deductions for 2025. And the standard deduction will increase in 2025, rising to $30,000 for married couples filing jointly, up from 29.2. So that's good. That's right off the top. And
Right.
starting in 2025, single filers can claim 15,000, a bump from 14,600. Okay, so that's good for us regular guys. In its
Right.
announcement, the agency raised the income thresholds for each bracket, tax bracket, which applies to year 2025 and returns filed in 2026. They boosted figures for dozens of other provisions, including long-term capital gains brackets, state and gift tax exemptions, and eligibility for child credit taxes. All these have gone up to help us. Okay, so
Right.
that's good. The bad news on that side is for us regular guys and gals is after 2025, these lower taxes, and these were the Trump tax cuts. I'm not trying to be political, but they were that they
Yeah.
say they only went to the rich people, did not. They will sunset unless Congress comes and uh, uh, institutes those tax cuts, and you'll go right back to your levels before. Okay, you're not going to get 30,000 as a. It's going to go back to 4 or 8 years ago what it was. And so
Wow.
again, all this stuff will go back to the norm, and you're going to be paying more in taxes. You're going to be in a higher tax bracket. The deductions are going to be lower. Child tax credits are going to be lower. If you inherit anything, I think it goes from 3 million or 13 million, 14 million of what it's tax free down to 3.5 million, which is going to hurt a lot of family farms around where I'm at. Okay.
Right.
And so just remember that this stuff matters, and you need to look into it. Make up your own mind.
Yeah, exactly. And I think that's, you look at it, what is the biggest expense for a consumer? It's taxes. You're taxed on everything. If you tax corporations at a higher rates, that is a tax on you and I as the consumer of that product. They will raise the prices. They don't stomach it. I mean, they don't eat that. They're going to pass that on to you and I. And when you go back and look at that chart, 87% increase in inflation in it's cost 87% more to live today versus 2000. When you start to think of it that way, it's like, wait a second, you're going to go after big corporations and make them pay their fair share? No, we're going to pay that because that always comes to us as the consumer. And I don't
And
think
that's
people understand that. Billionaires have teams of tax accountants and tax lawyers. Don't think they're not working any angle that's going to be thrown at them after the election. They're not going to pay more. It's you and
no.
I who will.
Yeah. And if that sunsets, the Trump tax cuts, and we're all going to be paying more. We're going to go in higher tax brackets. Our deductions are going to go down. You're going to pay more for death taxes. Your child credits are going to go down. It's just going to be bad.
Yeah.
And that's going to be
And
bad
I
for
think,
us, but not for the people that have tax lawyers and tax attorneys.
right. And I think this is one of those things. It's like, this is when you start to pay attention. This is when you start to realize who you're voting for and the policies they're trying to implement. And not to get political in any way, either way, you're going to pay something. It's a matter of how do we get back to where every household in this country can be profitable again, can have extra money left over at the end of the day. Put aside their spending, their ridiculous, I got to have this attitude, but get to a point where you could have the choice of having a profitable household. That's where we need to get to.
Yeah,
Um,
absolutely.
yeah. So,
We talk about it every day here in the Platinum Channel. We talk about using technicals and then fundamentals on the Gold Channel, and put it all together. And we have a lot of people who participate because we just don't do it on our own. We talk to people who live everyday lives like we do, and what they're experiencing, and what are the best strategies that we see or they see to make it forward and get through all this.
yeah, that's it. That is it. That's what we do here at Best of US Investors. Check us out at www.bus13.ai. That's www.bus13.ai. We have three different levels. The silver level, which is a Sunday newsletter that goes over really the cornerstones of the different cornerstones of investing. So the S&P, the bond market, European developed markets, along with emerging markets. And we put out a newsletter every Sunday. That's $9.95. The Gold Channel consists of a lot of things, and a big part of that is the fundamental analysis Kerry does on his AI stocks that he likes. Along with you get access to a whole list of different things, and then everything comes into the Platinum channel. Now, Mark has been running the Platinum channel for years now. He is into the swing trading side of things. He puts out a watch list every Monday, along with commentary throughout the day, throughout the week, along with a handful of other things, and everything that you would have gotten in gold and silver and whatever else we can jam into the Platinum channel. And that's $60 a month. So it's a great bargain, a great value for your money. And you get to learn stuff. And along with our community is super strong. That is probably the strongest part of all of this is our interaction with our community, our people, and really just the friendliness and kindness of everybody involved. So check us out at www.bus13.ai. And Mark, anything last words you got there?
No, just, watch out for yourself, take care of each other, and have a risk plan, for your financials.
What goes up will come down. It's
Well,
called
yeah,
gravity.
nothing goes up
Right.
forever.
That's right.
Just
All right. We will see you next week. In the meantime, have a great week. Be safe and always live loud. Peace. See ya.
and